Yo, what's up, Trade fam? Welcome back to Trade Like a Boss, the podcast where we spill the juiciest Wall Street secrets faster than a bull run. I'm your girl, Riley, total trading newbie turned obsessed chart chaser. And today, OMG, we're leveling up big time. You know, we're not just talking theories. We're talking about real, actionable strategies that can literally transform your approach to the markets. And trust me, you're going to want to take notes. We've got the one, the only, Mike the Maverick Harlan in the house. Mike's not just any trader. This dude's a 30-year institutional beast who's turned millions into empires on the floors of NYSE and beyond. He's seen it all, done it all, and frankly, he's outsmarted most of it. Mike, welcome. It's such an absolute honor to have you here. Your rep totally precedes you. Tell me, how does it feel to be the guy who makes hedge funds sweat, even after all these years?
Riley, darling, it's an absolute thrill to be cranking up the volume with you. It really is. And you know these young guns like you're the future. Keep that fire burning. It's incredible to see so many people, like yourself, really diving deep into understanding how these markets truly work instead of just gambling. I've dodged more market bullets than Indiana Jones has found ancient artifacts, and let me tell you, the real gold ain't in the specific trades you pick. Not really. It's always in the robust, well-thought-out plan that keeps you from going bust when things get tough. That's the secret, right there.
Yes, Mike, preach. I mean, that's such a powerful truth, isn't it? Okay, spill it. We're diving headfirst into this Wyckoff magic today. For all you newbies listening, and even pros who need a refresher on the fundamentals, Richard Wyckoff was this legendary trading pioneer who over a century ago basically cracked the code on how markets actually move, like a total boss. He figured out the underlying mechanics. But here's the tea. Most folks treat trading like a casino spin. All hope, no actual game plan, just throwing money at it and crossing their fingers. You say we need to totally flip that script, make it a straight-up business hustle, a strategic enterprise, not just a gamble. Tell us more about that mindset shift.
Spot on, Riley. Absolutely spot on. Listen up, traders. This is foundational. Picture this. You are the CEO of your very own financial empire. That brokerage account, that's your operating capital, not your piggy bank for wild impulsive bets. You wouldn't run a successful business by just hoping for the best, right? So why do it with your money? Markets ain't chaos. They run on ironclad laws of supply and demand, just like gravity pulls prices down, or smart money starts strategically stacking chips in anticipation of a big move. Hope? That's poison, pure and simple. It's what wipes out 90% of wannabes in this game. You can't trade with hope. Now, what we do instead is we build a meticulously planned checklist, a comprehensive decision tree that clearly says, enter here, exit there, or sometimes the smartest move is to just sit on your hands and wait for the right opportunity. It's Wyckoff's genius. It's all about top-down analysis, baby. Always start with the big picture, the general market roar. Then you zoom down to identify the strongest sectors, and finally, you cherry-pick the individual stocks that just scream winner. That systematic approach is what truly separates the consistent earners from the rest.
Whoa, CEO vibes? I'm totally framing that. That's an amazing way to think about it. Okay, hot take. Markets cycle like crazy, right? We see accumulation phases, then markup, distribution, and markdown. And it's so true that in a severe downtrend, like 80% of stocks tank no matter how fundamentally sound they are. It's like a rising tide lifts all boats, but a falling tide, well, it sinks most of them. But smart money, they're always rotating into the hot themes, always positioning based on the economy's pulse or specific events. So Mike, break it down for us. How do we spot those sector rock stars without just chasing rumors, listening to the gurus on TV, or relying on gut feelings? Because I feel like that's where a lot of people go wrong.
Boom, Riley, you're killing it already with these insights. You've hit on a critical point. Markets move in packs. Stocks don't solo. They herd with their industry buddies. Individual stocks, no matter how great the company, will struggle if their sector is weak. This is where relative strength comes in, and it's an indispensable tool. You want to overlay a sector ETF, say Tech's XLK or Energy's XLE, against the S&P 500, which is our benchmark beast. If a sector is diverging during a market pullback, that's your gold mine. While the overall index is diving, that specific sector holds flat, or even better, it starts to climb. That's institutions pouring in, quietly building a launchpad for future gains. Post-correction, kaboom, it explodes. This isn't about guessing. It's about observing where the big money is flowing. Always, always only chase the top 2 or 3 leading groups, folks. The rest, they're just dead weight, dragging your portfolio down. It's like picking the front runners in a marathon. Why limp along with the struggling pack when you can identify the ones about to sprint ahead?
Explosions? Sign me up. That sounds absolutely exhilarating. So, stock selection time. We're hunting for those market crushers. You're saying they're stronger than the overall index, right? Showing higher lows in the dips with institutional hugs metaphorically keeping them afloat. But then for entries, you're not just buying when it looks good. You're waiting for that spring, that clever fake-out dip below support, and then a quick snap back like a rubber band. Or those low-volume pullback tests? Chef's kiss. That's a whole different level of precision. But Mike, the real edge, the actual secret sauce to longevity in this game has to be risk management. This is where I think most new traders fall flat. Spill the deets on stops and that juicy 3-to-1 ratio. No more it'll bounce prayers, right? We need a concrete plan.
Ah, Riley, you've touched on the very heart of the beast right there. This is where the pros separate themselves from the gamblers, the wannabes from the consistent winners. Your entry point is your green light, but it's utterly useless without a predetermined exit plan. After you've identified a spring or a clear test of support, you slap that stop loss at the structural kill zone. What's that? It's a point where if the price goes below it, your entire premise for the trade is invalidated. It could be below the spring low or a fresh higher low in an uptrend, or even below a consolidation pattern. It's not an arbitrary number, it's a logical point. Now, the math, this is non-negotiable. You demand at least a 3-to-1 risk-reward ratio. You risk $1 to potentially make $3, or you simply walk away from that trade. If the nearest resistance level caps your upside potential to anything less than that 3-to-1 ratio, abort mission. There's always another trade. Psychology is absolutely key here. You treat losses like business expenses, cold, calculated, and just part of doing business. You don't get emotional about them. You plan your entire trading campaign like a war room. Pyramiding, which is adding to your winning positions, should only happen as the trade progresses and shows further strength. You trail your stops as the stock moves in your favor, protecting profits. And emotions, you leave them at the door because they're detrimental. It's a contract with yourself. You break it, and the market, sooner or later, will break you. It's that serious.
A contract? I'm signing that in blood, seriously. That's such a powerful analogy. Okay, traders, pause and rewind right now. This is your viral hack right here, the stuff they don't teach you in school. But wait, the crown jewel, Wyckoff's 5 killer questions you must answer before pulling the trigger on any trade. Mike, let's unpack them like a Black Friday haul, one by one. I mean, this is the ultimate pre-flight checklist, right? Question 1. What's the trend of the general market? Because as you said, the tide lifts or sinks all boats.
All right, let's dive into these. Number 1, Riley, you absolutely have to do a trend check on the big boys, the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. Are we seeing higher highs and higher lows? Then, my friend, we're in a bull charge. That's your green light for aggressive long trades. Are we stuck in a sideways range? That's probably accumulation, where the smart money is quietly loading up their positions, building cause for the next big move. Or are we in a clear downtrend with lower highs and lower lows? Then cash is king, because 80% of stocks bleed out during those times. You only want to be swinging for long positions in markup phases post-accumulation. If there's no clear trend, you know what? There's no trade for you. Simple as that. It keeps you from fighting the powerful market tide, which is a battle you will rarely win.
Trend or bust. Got it. That's a fundamental rule. Question 2, which group or sector is leading the pack? Because we know those hot sectors can carry a lot of individual stocks with them.
Exactly. 2, sector sleuthing. This goes back to our discussion on relative strength. You need to identify the strongest sectors by using that relative strength overlay during market corrections or even just pullbacks. The leaders will actively resist the market's drop. They'll hold up much better and then they'll rocket forward on the rebound. Institutions are always chasing economic tailwinds, maybe tech and growth cycles or energy and inflation plays or consumer staples during uncertain times. These are powerful forces. So ditch the laggards, the ones that are just barely moving. You want to ride the rocket fuel of the leading sectors. This significantly increases your odds of finding a winner.
Rocket fuel, obsessed. Love that imagery. Okay, 3. Is this specific stock a market muscle? I mean, stronger than the overall market. How do we really test that strength?
3, the decline test, baby. This is crucial for individual stock selection. While the general index is cratering, does your potential stock hold steady, maybe even grind higher, or at least show significantly less weakness than the overall market? You pair that strength with evidence of post-accumulation basing. That's sideways action where the big boys are clearly accumulating shares. You want to enter in your breakout points from that base with what we call fresh legs, meaning it hasn't already made a massive move. That's your breakout fuel. The stock is ready to run. If it's weak sauce, if it's falling with the market, or worse, falling harder, next. Don't waste your capital on it.
Fresh legs for the win. I love that. So important to not chase something that's already extended. 4. Where's the trap, that sneaky entry point like the spring you mentioned? How do we identify that precise moment?
4. Setup City. This is about precision entry, Riley. You're looking for those classic Wyckoff setups, springs, shakeouts, tests of support. You wait for that fake out dip below a critical support level, which traps all the weak hands, and then you see a rapid snapback, a strong reversal. That's your ideal entry. Your stop loss, remember, goes at the invalidation point, safely below that spring low or below the new higher low. And you math check your 3-to-1 risk-reward ratio to the nearest resistance lines before you even think about entering. If the trap isn't sprung, if the setup isn't crystal clear, or if the math doesn't work out,